Happy May 1st, 2025, everyone. May already. Never thought we'd get here, but here we are. And I have one admission. I was hoping to release videos more often, but I have to wait till it's ready and actually running properly. So for the time being, when I get excited with the new project I've been working on and it's ready, I'll make a video. So I guess that's not going to help for my YouTube algorithm, but if you want to like the videos, that would help. So what we're going to look at today is IRAs. If you're starting out in the workforce and you've got a choice, you have the 401ks at work, and those are great too. And I'll probably do a separate videos doing compare and contrast. But for this one, I want to look specifically at the normal IRA, individual retirement account, or the Roth individual retirement account, Roth IRA. And they both have unique qualities to them. Specifically, the normal IRA lets you take a pre-tax deduction on your earnings, whereas the Roth IRA lets you withdraw. You're using post-tax money, but you can withdraw tax-free. So all the gains you make in the Roth over the duration will be yours. So they have pros and cons. You get the tax deduction early, or you get the tax-free withdrawals later, depending on your returns. And I just want to take a very simple look at it. Giving fixed return rates, giving fixed income growth over time, and see what it looks like to do a comparison between the two. And are they the same, or do you actually see a benefit from one or the other? So let's dive in. Normal IRAs versus Roth IRAs. So what I did is I'm going to go to my handy dandy recall, and we see that I just plugged in some basic general stuff. Oh, this is actually 5100. This is data from the Census Bureau and the BLS that what is the monthly average single income in the U.S. And this is actually 2022 numbers, so I'm going to go with that and just run it through the cycle. But we see, over time, and this is indeed 30 years, so I'm starting at age of 30, and I'm going to run to age of 60, because 59 and a half is when you can start withdrawing funds from your IRAs penalty-free. And just to go over the inputs here, again, I've got a monthly income of $5,100 that I'm going to be doing for 30 years. I've got an IRA that I'm also going to be doing for 30 years. I've got a taxable account, like a stock account or a savings account could be that, or I'm getting a minimal return rate here. And then I've got my average, again, based on census data, average monthly expenses of $3,700 a month. And then also this increases with inflation. And you can see that this ends up with $857,000 over 30 years, which is a nice amount. And that's assuming, let's see what my transfer is here. I go into my monthly income and I say, okay, I'm moving 6% of my monthly income to my IRA. And what does that give me? That gives me $306 a month coming in to my IRA. And I might be able to go a little bit more, but I didn't want to go so crazy as like, put all of your extra cash into an IRA. Just, something that seems kind of reasonable. And as we see here, it grows very, very nicely over 30 years. And you might notice on the right-hand side here, I've got a report. So it details every year exactly how much money you earned, the IRA contributions you made, and the appreciation you returned. So you basically check my work if you want to, make sure that nothing's too far off. But this would be the progression if you had this nice linear flow of IRAs going into your account over 30 years. And now the question is, great, this is my IRA. How can I now see what my Roth IRA might be for the same parameters? Well, let's check it out. We will drop down, select Roth IRA, and recalculate. Well, before I hit the recalculate button, I'm looking. This is $935,000. Okay. Recalculate. Oh, if I do the Roth IRA, I go down to $889,000. Interesting. And $277.05. So this looks like if I go back to a normal IRA, it goes to 935,000. I get more. That is most likely due to my pre-tax contributions, which reduces my tax liability. So if I go to the growth view, we can see right here, this is my current normal IRA, and I've got taxes, like 12,000, here in 2036 is 13,900. Whereas if I go and change that to a Roth and recalculate, it is indeed a little bit higher. Look at that. So it went from like 13 to 14, 15,000. So I guess that's it, right? The normal IRA wins. There you go. Open shut case. Hold on, there's more. A great job saving money over 30 years, either into your IRA or your Roth IRA, but that's not the whole point of things. You also want to spend that money in your retirement. So let's add that to the equation. We're going to add another 15 years to our modeling here and see if that makes any difference to the full experience, the full Roth or IRA experience. But before we do that, I just want to address something. I'm doing the second cut here of the video, and you notice that I started out at 857, and then I said, with the normal IRA, you go up to 935K. The reason for that is I had not recalculated after updating to 5,100 a month. So if we do that right now, and we say 5,100, recalculate, hey, look at that, we're at the 935. So sorry about the confusion, but yes, it should have been 935 from the very start with a normal IRA. But let's add those 15 years. What I did is in the B register, I'm going to recall that. I've already laid this out. And this, still goes to 2055, but now I'm going to add Social Security starting in 2055 and going another 15 years. Likewise, I've extended the lifespan of our IRA to 2070 as well. We've also got a taxable account going to 2070. And you'll see the monthly expenses. This one, it topped out at $9,100 a month in 2055, but all the data says that you actually reduce your spending, you reduce your expenses once you retire, and you need like 80% of your income. So I thought, all right, well, I will take my expenses down by 80% and go from there. So that's why we see this starting June of 2055, going to 2070, starting at 3290, which is 80% of 9,100. That's a lot of numbers. So you'll see that we actually have crunched the numbers, and our normal IRA will yield $882,000. Let's go all the way back. Let's see. Yep, 5,100. Recalculate. $882,000. So we see the spending here is we reach 2055. It looks like we go up a little bit still, and then those expenses start creeping up and catch up to us, and we going down. But that's a great profile, because that's what I want. I probably could extend this another 10 years or so, but I'm pretty confident you'll still get some green here. And you'll notice that let's see, in our transfers, I believe we're doing 80% from the IRA, for our spending. Just 20%. So that's why you see the IRA going down quite a bit faster than the account. But that's fine, because we're going to have to pay that money anyway. Because remember, this is a normal IRA. I'm paying the taxes when I pull it out. But let's see what a Roth IRA looks like, given all these same numbers. We'll do the same trick. We're just going to select from IRA to Roth IRA. And before we hit the recalculate, all right, so our normal IRA, after 40 years, 45 years, 40 years, 45 years, is at $882,000. So if I switch it to a Roth IRA, recalculate, this is interesting. So now, because I'm getting my gains tax-free when I pull them out, I'm actually doing a little better. I mean, not huge over time. This is 45 years, but still, I'm over $1 million by 2070 with the exact same profile of saving and withdrawing and spending funds. And as you see here, I've just, because that I don't have the same tax hit that I do with the IRA, the normal IRA, I've got more money in my Roth piggy bank, and that's contributing to my funds. So that's interesting. What does this all mean if I'm 30 years old and going forward? How should I put my money into which buckets? Well, Roth IRAs look pretty good, and I think you would seriously want to do a 401k because there's a little subtlety here. You'll notice that I was using the normal IRA and taking a deduction pre-tax. However, if you are working for a company and they do have a retirement plan available, like a 401k, then you cannot take that IRA pre-tax deduction. So in that respect, you actually do want to do the 401k is much preferable over the IRA, normal IRA, because you can do that pre-tax deduction. So with that, you do get the best of both worlds, 401k, IRA, and save that money, and you'll have plenty for retirement. And I think next video, I'll probably add a 401k to the mix. So with that, have a great day.